let's start right there, because we've seen this rekindling of the animal spirits. I think back to earlier this year, it might have been March, as early as March in the year. And you said, hey, the Fed may not cut at all this year. We know that was wrong. They've cut 75 basis points. But your thesis behind it was that we could see a no landing scenario. How do you see the economy now?
Well, I do see the economy still as very strong. If you look at the incoming data for retail sales has been very strong. The incoming data for durable goods has been really strong. GDP in the third quarter was 2.8. The Atlanta Fed estimate for fourth quarter GDP is 2.5. Remember, as usual, GDP has to be more than the long-run growth of 2%. So the backdrop really is very strong growth still in the economy. And now with the tailwinds coming from potentially lower tax cuts, some deregulation, we might get something on tariffs, we might get something on immigration. But broadly speaking, at this point, it looks like the tailwinds to the U.S. economic outlook continue to be very strong.
How many of those tailwinds are structural? And if you end up seeing fewer rate cuts in this environment, is that because of stronger growth, or is it because of the possibility of inflation picking up its head a little more meaningfully again?
Yeah, this is very important, Morgan, because if you think about it, the Fed started raising interest rates in March of 2022, and we really never, for the last 2.5 years, saw the economy slow down in response to the Fed raising rates. So now the Fed is actually cutting rates. They've just cut a bit, 75 basis points, but it's enough to, even before the election, trigger a significant rally in the stock market, significant tightening in credit spreads. IG high-yield loan spreads have been tightening to record lows as we speak. All those tailwinds, combined with the CHIPS Act, the Inflation Reduction Act, the Infrastructure Act, and also, of course, the tailwind from the data center boom, the AI boom. I mean, there's just a lot of things that are powering the economy along. So that's why if we now add to that the probability that we may get some tax cuts. Trump has been talking about a 15% tax rate for domestic manufacturers. All that, again, continues to argue for the economy still doing well. And you're right that the upside risk with that is potentially some higher move up in inflation. But it still remains to be seen where we're going on the inflation front. But for now, it's very clear that the growth outlook continues to be very solid.
Torsten, with this talk about rates, are you counting on a Fed that will operate as it has in recent years without obvious influence from the president? I mean, some expect incoming President Trump wants more influence there, and we know he likes low rates.
Well, I think the Fed, and we got an answer that was very clear from Jay Powell last week. I think the Fed will continue to focus on the dual mandate. And the dual mandate, of course, is inflation at 2% and full employment. So with a near-term outlook of relatively strong growth and potentially even a near-term outlook of a quite significant number for non-farm payrolls for November. Remember, the survey week for non-farm payrolls is the week of the 12th, which happens to be tomorrow. So that means that this week is the week when the BLS will measure what is job growth in the month of November. And given we're just after the election, given the boom we're seeing in risky assets, the stock market, in credit markets, capital markets doing well, both with issuance, of course, in particular for IG, but for credit looking well. Also IPO and M&A activity also looking broadly better. That could potentially be a tailwind for creating quite a jump in non-farm payrolls for the month of November, in particular combined with the reversal of the weather and strike effects that we had in October.
Well, another policy question then. We've got one party and an incoming president with an amount of power I don't recall seeing in my lifetime, including a Supreme Court that has shown an inclination to let executive power run. So we were just talking about this with Dana D'Auria. Do you think that means tax cuts without the pay-fors, and what would that mean for inflation?
Well, there has been several scorings of both the Harris plan and, of course, more importantly now, the Trump plan from both the Committee for a Responsible Federal Budget. It's also been scored by the Penn Wharton budget model. It's also been scored by the Tax Foundation. And all these three independent scorers, they have found that we should be looking at more Treasury supply coming over the next several years. In other words, it is not fully paid for, at least according to those types of scoring that we've seen there. So that's why Treasury markets, we have seen that steepening of the yield curve now for quite some time that I think we should expect to continue, because long rates are not only moving higher because of Fed expectations changing, but long rates are also moving higher because the term premium is moving higher. In other words, because there's some renewed fears about potentially fiscal sustainability becoming a factor for long-term interest rates. So yes, short-term interest rates will stay higher for longer, and long-term interest rates will probably also stay higher for longer, which means that private credit, spread product and credit more generally, should continue to do well and give yields that are significantly higher than we had for the period from 2008 to 2022.
All right.